When it comes to depreciation, there are two methods. One is, as I said, straight line, and the other one is called double declining balance. Straight line allocates an equal amount of cost to each period, whereas straight line allocates an equal amount of cost to each period, whereas double declining balance allocates more cost to the earlier periods and less cost to the later periods. So the cost, in essence, the amount of cost applied each period is going to decrease each period. We're only going to do straight line in this class. Let's just go over some terms. PP&E is also referred to as, well, property, plant, equipment is also referred to as PP&E, or fixed assets. It can also be called capital assets. So when you see capital expenditures, that's the amount of money the company spent on PP&E, on property, plant, and equipment. Acquisition cost is the same thing as original cost or historical cost. And we've talked before about the historical cost principle. And this is how much you originally paid to purchase the asset. Another important concept is the idea of residual value. When you buy the asset, you need to estimate how much the asset is going to be worth at the end of its useful life. So you buy the asset, you say this asset is going to be good for, I don't know, 10 years. And in 10 years, I should be able to sell it for $1,000. That $1,000 would be what we call residual value. It could also be called salvage value or scrap value. So don't be confused if you see the term salvage value or scrap value. An important term in applying the formula is something called a depreciable base. This is the total amount of depreciation that you need to record. And the formula for it is acquisition cost minus residual value. And remember what depreciation is. Depreciation is the allocation of the cost of the asset over the life of the asset. Well, let me just give you a little more specifics there. It's the allocation really of the depreciable base. We don't need to allocate the residual value because the residual value we're going to get back. We're going to get the money back. And it's really over the expected useful life of the asset. And again, we're going to talk here about straight line. Keep in mind there's another method called double declining balance. Accumulated depreciation is the total amount of depreciation expense since acquisition. And the acquisition cost minus the accumulated depreciation, as I told you before, is called book value. And this is a key formula. Other terms for book value are carrying value, PP&E net. The term net there is really important. Or cost not yet depreciated. And book value is what you report on your balance sheet as the total, as the value of the assets. Now let me show you how straight line works. I'm going to do this along with you in this particular video. Equipment costing $400,000, looks familiar, has an estimated useful life of 5 years. That's a little different than before, because before we were saying 8 years. This equipment has an estimated useful life of 5 years and a residual value of $50,000. Record depreciation expense, accumulated depreciation, and book value in this chart. So your annual depreciation expense here is going to be equal to $400,000 divided by, 400,000 minus the residual value would be your depreciable base, divided by the useful life of 5 years, like so. So depreciable base divided by the by the year's useful life. So in this case, this would be equal to 70,000, because 400 minus 50 is 350,000 divided by 5 years is 70,000. So your annual depreciation expense would be 70,000. So year one, depreciation expense, 70,000. That would mean accumulated depreciation in year one is also going to be 70,000 because that's the total amount of depreciation that you recorded so far. Book value would be 400,000 minus the accumulated depreciation minus 70,000 equals 330,000. In year 2, it's the same amount of depreciation expense because we're using straight line. The accumulated depreciation here is 140,000 because previously it was 70,000 plus 70,000 more is 140,000. It's also the total of these two figures, 140,000. So now your book value would be equal to 400,000 acquisition costs minus the accumulated depreciation of 140,000 is 260,000. Year 3, depreciation expense is, again, 70,000 because it's straight line. Accumulated depreciation is going to be 210,000. That's the total depreciation we recorded so far. 70 times 3 years is 200,000. And then the book value will be equal to 400,000 minus 210,000 equals 190,000. That's what we'll report on the balance sheet. In year 4, depreciation expense is 70,000. Accumulated depreciation is 70,000 times 4, or 210,000 plus 70,000 is 280,000. So therefore, book value is equal to 400,000 minus 280,000 equals 120,000. This is the best part. Watch this. Depreciation expense in year 5 would be 70,000. Accumulated depreciation is 350,000, and therefore book value would be equal to 400,000. This is my favorite part. Minus, hold on. This is the good part. 350,000 equals 50,000. And what was the residual value? Residual value, we said, is 50,000. And here's 50,000. Here's another cool thing. Total depreciation expense is $350,000. Does that look familiar? That is the depreciable base. 400,000 acquisition costs minus the 50,000 in residual value is 350,000. So there's a little chart here you can fill out. Each year try it out now. You know, fill it out and then we'll do it together. All right, you got it? Depreciation expense each year is 70,000. The acquisition cost was originally 400,000, and the accumulated depreciation, let me just make this a little smaller, was 70,000, resulting in a book value of 330,000. Year 2, 400,000 minus 140 is 260. Year 3, 400,000 divided by 210 minus 210 is 190. Year 4, 400,000 minus 280, right? 210 minus plus 70,000 is 280, would give you 120,000. Year 5, 400,000 minus 350 is 50,000. I know what you're thinking. Why do we need to do this all over again? Because we're kind of just doing the same thing all over again. But watch what happens in year 6. This is the cool part. In year 6, the acquisition cost is 400,000, but we need to stop depreciating. We've already depreciated the whole thing, so this should be 0. Accumulated depreciation remains at 350,000, and the book value is 50,000. There's no more depreciation to do here. So it's just going to remain on the books as it is.